Welcome, everybody. This is Macro Money. I am Ilya Spivak, head of global macro at tastylive. And this is perhaps the show that we've been waiting to do all week. There's been really a singular focus this week on one number, really, as we continue to really focus across asset classes on what the Fed is going to do and how the markets are going to react. Of course, there was an explosive jobs report on Friday that created all manner of volatility around this narrative. And the next big inflection point in this story is the December U.S. CPI report, which is coming to us tomorrow. So, with that in mind, we are going to set up a view on what could be coming out here and how we might benchmark it and where this could take markets next. So let's take a look here, and first we'll see what it is in these numbers that could be market moving, see what might be already baked in, see what maybe still has potential to inspire speculation, and then attempt to figure out how that speculation might go depending on what the outcomes are. Really, the mission here is to get a sense for whether the kind of explosive response that we got to the jobs report, and in particular the inflation component in that jobs report, could be repeated here, in which direction that response may go. So first, let's take a look at expectations. We are looking for the headline number. Let's start there, to actually turn negative and for inflation to come down from November into December by 0.1%. That would take the CPI year-on-year number, which is what you might call baseline inflation, from 7.1 to 6.5%. The key number that we're going to focus on here, though, is going to be the core figure, because this is what factors into the Fed's calculus. This is really what the Fed is looking at. They're looking at inflation excluding volatile items that tend to swing up and down in an outsized way on a given month, and sometimes can obscure the sort of central tendency in where inflation is going. And here we're looking at 5.7% on the year-on-year CPI core number, the one that excludes food and excludes the view that energy is a particularly volatile component here. Now, that would be the lowest number in a year. So that would be easily the lowest number in 2022, the lowest since December of 2021, where we registered around 5.4%. Now, we are going to contextualize this through the lens of what the Fed actually expects to happen. So what we're focused on is that 4.8% number. Now, this is an important distinction. And before we get into the mathemagic segment of the show here, which we're going to spend a bit of time with, let's make sure we make this distinction. The Fed's target number that they're looking at isn't the CPI. It's the PCE, which is the personal consumption expenditure inflation measure. And again, their focus is on the core. That's really the thrust for policy. So what we have here is the summary of economic projections as the Fed had it. So this is as of December. And what we're going to focus on is that 2022 number, because this is what we should get clarity on, whether the Fed got their number or didn't, and how that will influence policy expectations. And so the first thing that we're going to do is we're going to see how one goes from CPI and to the PCE number and see what this release that we have over the coming day is going to mean once we put it in terms that are Fed relevant in the most significant way, and then see what might be the market implications, because, of course, investors will be doing much the same thing. So I've laid this out in steps, and we'll go through this slowly, because this is going to be maybe a bit involved. So first, we know that the Fed has a forecast of 4.8% inflation for 2022. What is that number actually? It is the change fourth quarter on fourth quarter. So the level of inflation from the fourth quarter of 2021 to the fourth quarter of 2022 is expected to have increased 4.8%. Now, importantly, this 4.8% is a median number. The Fed set of officials, the FOMC committee, they actually give us a range of outcomes. That then is narrowed into a central tendency. That central tendency is then further narrowed into this median number. So this isn't an absolute. The Fed is not going to stand by the 4.8%, but nevertheless, it's a good roadmap for us to figure out whether things are developing as the Fed anticipates. So we're going to take this as baseline and say, okay, the core PCE index, the actual level, we can see that here, 119.55.56, and we're going to upscale it by 4.8%, which is what the Fed is calling for, and get the number that we need to have on the index for the fourth quarter of 2022 for what the Fed is looking for to actually get realized. Then, since, of course, this is not going to be the PCE number, this is going to be CPI, we're going to benchmark what that gap between these two measures usually is. And typically, the PCE number undershoots CPI. CPI typically runs in parallel, but a step higher. And if we look at the history, we can see that generally the discount from CPI down to PCE is about 0.25 to 0.27% for the month-on-month measure. Now, why do we say 0.25 to 0.27 versus just an average of 0.26? Because this takes a look back period going all the way back to 1972, which is the first year off the Bretton Woods system of fixed exchange rates, or at least exchange rates that are as pegged as the last we've had them, in that case to the US dollar. Before then, it was the gold standard and things were pegged to gold. So we're looking at really the modern period of floating exchange rates, and most importantly, a floating US dollar as the look back. In that time, from 1972 out to 2022, in those years, obviously, that there has been a whole host of different things that have happened in the U.S. economy. So to average everything together would give us a bit of a muddy view. We would perhaps be painting with too broad a brush to really say the economic conditions that we had in the 80s versus 90s versus after the global financial crisis in 07, 08 versus after the outbreak of COVID in 2020, that these things are necessarily perfectly comparable. And so instead, what I did here was I looked at what the numbers were for the periods, the various eras, and actually they were remarkably similar. The gap between CPI and PCE really did, for the various eras, stick in that range of 0.25 to 0.27. So what we're going to do here is we're going to use 0.27, the upper part of the range, to essentially be the most conservative that we can be. To say that we are going to give this the benefit of the doubt and say that we are going to create the most kind of conservative view of what this adjustment could be. So, with that in mind, we apply the discount of 0.3 to 0.5%, and we land at a monthly PCE number, as you can see here, of 0.25 to 0.27, as we just said. Taking that 0.27 with knowledge of what the November PCE index is, we can forecast a December number, which you can see here is 125.48. From there, we can take a simple average of those three numbers, October, November, December, and land on the Q4 number that would be expected if we got the CPI and then the PCE month-on-month numbers for December that we expect. That gives us 125,185, which you can see at the bottom of that third step there. With this knowledge, of course, we can see a couple of things. First of all, the number we needed to get to the Fed's forecast is higher. Second, we can actually see what the number would be if this all lines up. So if we had to mark a rise from 119.55 in step one there to 125.185, that would give us 4.7%. That's that first box you see in step four. Now, this feels like it's not really a big deviation. The Fed said 4.8. That 4.8 is the median in a range. 4.7 is well within that same range. So really, this should not feel like a big deal. This should be about what one would think the Fed would anticipate as in line with expectations. Except for when we actually back this out. Because what happens, of course, with numbers like year-on-year numbers that are then made into core numbers, all of this is a form of smoothing. Have a look at month-on-month numbers versus year-on-year numbers. The year-on-year ones look much smoother. The trends are much more easily identifiable. On a month-on-month basis, that shorter look-back period means there's a lot more volatility in the numbers. So when we actually take that 125.185 and we back it out in reverse, and we say, okay, if we have these expectations for what the number would be if core CPI landed at 0.3% as expected, what would it have to be if the 125.294 number that we need in step one, if that number were to be reached and all of these same adjustments were to hold, what would we need to see month on month from CPI tomorrow? And we can see the difference is much more stark. Here you can see we would need to have a rise of 0.75% month on month on CPI, again, with all of these assumptions. We're scaling by 0.5% for the CPI PCE discount. We're using the assumptions as we've laid them out going the other way. Now, 0.75% first of all, would be a tremendously significant upside surprise, a long ways from the 0.3% that's anticipated here, especially since markets are expecting for inflation to slow, not for it to accelerate. And so this would be not only a significant move in the direction that the markets don't have in the forecast, but also by a huge magnitude. So if we take a look back here at these expectations, we can see again CPI excluding food and energy here, expected to fall at headline, expected to decline at core. So with that in mind, 0.75% as different from 0.3% would be a major upside surprise. Well, wait, there's more. Take a look at how frequently a rise like that has actually occurred for the core month-on-month number. And what you see here is it is not exactly something that's frequently occurring. We have a situation here where, of course, we hit that kind of a number at the peak of this inflation cycle in 2021, but of course, since then, the Fed has aggressively moved to tighten, and these numbers have come in. Aside from that spike in 2021, the last time we were looking at magnitudes like this was in the early 1980s, when famously Paul Volcker attacked inflation with a similar vigor. It's really the only rate hike cycle more dramatic than what we've seen here so far. And of course, as you can see from the numbers on your screen there, inflation was really dramatically high in the early 1980s. We were getting rises of over 1%, well over 1% on a month-on-month basis. And then after Volcker's actions to aggressively tighten, inflation was basically beaten into a narrow range and really hasn't perked up the way that it had before until this latest go-around. So to get a 0.75 number on a month-to-month basis seems to be relatively unlikely. What that means is that we are skewed asymmetrically in the direction of a number on this CPI release that is going to undershoot what's necessary for the Fed to meet its forecast. What would that mean? Well, first of all, let's consider how economic data on inflation has behaved so far. And you can see that with the Fed's actions, this is data from Citigroup showing the surprise index that they construct. They look at economic data, see if it surprises to the top side or undershoots, and scale that for the index by how much the market's actually moved on that. So this is not just an index measuring surprises relative to expectations, but also informs that index by market moving response to those surprises. And you can see here that for a substantial period now, several months, really the bulk of last year, inflation numbers out of the US have increasingly faded relative to forecasts, which means the markets, for now, whatever modeling economists are using, different ones, it's different, whatever models major financial institutions are looking at to generate these inflation forecasts that then go into median market expectations, those models are overstating realized inflation still. Now, of course, it is a moving target because the Fed has engineered, as we said, the second most aggressive rate hike cycle in the current sort of period of existence, in the current kind of regime for global financial markets going back to the early 1970s. But nevertheless, here we are. The market has tended to overestimate inflation, and realized results have increasingly undershot, which of course would reinforce the idea that this number that we're expecting and the number that we might actually get are probably significantly apart. So not only are we probably not going to get the 0.75 that we need for the Fed to hit spot on its forecast, there is a significant risk here that even the 0.3% number might get missed. What would that reaction be? Well, let's go back to what we saw from that jobs report that we mentioned at the top of the show. Importantly, notice I didn't even include the headline non-farm payrolls increase, didn't include the unemployment rate, didn't include the participation rate, because these numbers generally were not the kind of things that might inspire the reaction that we see. All of those numbers were a little bit better than expected. Headline payrolls growth overshot expectations. Headline unemployment numbers a little bit lower than expected, which of course is good news. And the participation rate even ticked up a little bit. The main takeaway here actually seemed to be the wage inflation component of that jobs report, and subsequently December's services ISM number. On the inflation number, the wage inflation number, we came in much lower than expected, 4.6% versus 5% expected. And the prior number, the November number, was actually revised down from 5.1 to 4.8. So we're looking at not only softer wage inflation in December, but softer than expected wage inflation revised back in November. Not surprisingly, dollar falls, gold goes up, S&P goes up. This is a textbook response that seems to scream the markets took the data to mean the Fed may end the rate hike cycle sooner, although for now it's still anchored around June. There is increasingly a conversation of perhaps it could be sooner. And perhaps even more importantly, they might hold at that peak level for a shorter amount of time. And increasingly, the expectations for the back half of this year envision more and more likelihood for cuts already this year. And this is despite loud naysaying from Fed officials who do not want to telegraph that rate cuts are anywhere in the near-term vision. Then, of course, you get that services ISM number, which frankly comes in god-awful. The expectation, again, severely undershot. 55 is what was expected. 49.6 is what came out. There's a number of reasons why this is very important. We'll just summarize them here because we discussed NFP at length earlier in the week and the ISM number with it. This works just like PMI or Purchasing Manager Index data, where 50 is the center line. That's the place where the service sector is neither expanding nor contracting. Above 50, it's expanding, and the further it goes above 50, the faster that expansion. Below 50, it's contracting, and the further down we go, the faster the contraction is. This is what's called a diffusion index. So what we're looking at here is the service sector in the U.S. in December, which is by far the largest employer, by far the biggest contributor to U.S. economic growth, not only didn't grow as anticipated at a relatively upbeat 55, it unexpectedly contracted. That, of course, is very bad news. And something that the market ostensibly looked at and said, okay, well, the payrolls number was a little bit better. The unemployment number was a little bit lower. Even the participation rate was a little bit higher. Fine. But those numbers are lagged. The ISM numbers are much closer to real time. And that's telling us that the biggest engine of U.S. growth is in contraction mode. So not surprisingly, the takeaway was fewer rate hikes, sooner policy pivot in a dovish direction, a lower dollar, which we're benchmarking here as the UUP ETF, higher gold. The big takeaway is that this is still seen as relatively risk-on, relatively good news if we consider what's going on with stocks. Stocks here clearly responding with gold, moving higher on the prospect that the Fed might need to take their foot off the gas. But what that also suggests is that the market is perhaps not yet reckoning with why the Fed would need to pivot. And this is, of course, because economic growth is souring significantly, and as we can see from the ISM number, more so than expected. The takeaway there for this CPI number that we have is at some stage, and we don't really know when, this could be when, if the number is bad enough, if it misses by a big enough margin, sure, the dollar might fall, sure, gold might go up in the same fashion that we see here because of the implications for near-term Fed policy. But at some point, it stands to reason that the markets would go, why is this occurring? What are the implications for growth if these numbers are coming in weaker than anticipated? And the response from the S&P and risk appetite in general might start to focus less on the near-term nuances of whether the Fed will do 25 basis points more or less in the first half of the year, or whether they'll cut by 25 basis points closer to the back half of this year or early next, but rather focus on the growth implications. And if that were to give us risk aversion, if the focus suddenly became recession risk, as it seems invariably likely to do, unclear that it's going to be with this announcement, but surely as conditions deteriorate, and that hits corporate earnings, in particular as we begin earnings season here, that will begin to register, then a particularly large miss on CPI might actually give us a risk-off response, even as gold goes up, because rate hike expectations are pulled in. And this may feed back into the US dollar as a haven asset, as a refuge of liquidity when markets cash out. And so we might be on the cusp of a reversal here, thematically, where on the one hand, markets say the Fed needs to back off. Things are looking weaker. Inflation is softening. But on the other hand, that may not necessarily be continual good news for the S&P. And we'll see where that pivot is and if the deviation that happens in CPI here is enough to drive that narrative. And if it stops being good for the S&P, does it then perhaps start to become positive for the US dollar? Not for yield-seeking reasons, mind, again, but for safe haven reasons.